Nobody at the IRS is reading your tax return. Not this year. Not last year. Probably not ever. A computer is. And that computer is not looking for anything you did wrong. It is looking for two numbers that should match and do not. That is the whole thing. That is what an audit actually is for somebody in retirement. Not an investigation, a mismatch. And there are 5 places where retirees' numbers routinely fail to match, and 4 of the 5 involve money you never received or money you already paid tax on years ago. So let me say the important part now, rather than at the end. The single most dangerous idea in this entire subject is that following the law protects you. It does not. Following the law is necessary and it is not sufficient. Because when that letter arrives, the agency does not have to prove you did anything wrong. You have to prove you did it right. That is called the burden of proof, and it sits on you, not on them. They ask one question. Can you show me? And if you cannot, a completely legal, entirely correct position collapses anyway. Not because it was wrong, but because you could not document it. Which means the goal is not to avoid the letter. Some of you are going to get 1 no matter what you do. The goal is to be somebody who opens that letter, pulls 1 folder out of a drawer, and is finished in an afternoon. So here are the 5 flags. What each one is, why the computer catches it, and the single piece of paper that ends the conversation before it starts. My name is Kevin. I read the rules so you do not have to. Every week I go looking for the thing that quietly decides what happens to your money, and I bring it here before it costs you anything. If that sounds useful, subscribe and turn on the bell, because the first flag on this list carries a penalty that shrinks by more than half if you catch it inside a specific window, and grows if you do not. Flag number 1, the distribution you did not take. Once you reach 73, you are required to withdraw a minimum amount from your traditional retirement accounts every year. Not suggested, required. It is calculated from your account balance on the last day of the previous year, divided by a figure from a table based on your age. Here is why this is the easiest one for a computer to catch. Your account custodian files a form with the government every year reporting your balance. So the agency can calculate what you were required to withdraw before you do. And they can see what you actually withdrew, because that gets reported too. 2 numbers, theirs and yours. If they do not match, the computer notices without a human ever being involved. And the penalty used to be brutal, 50% of whatever you failed to take out. That has been reduced to 25%, which is still severe on a fixed income. But here's the part almost nobody knows, and it is worth real money. If you correct the shortfall inside what the rules call the correction window, generally through the end of the second year after the one you missed, that penalty drops from 25% to 10%. And if you had a genuinely reasonable cause, illness, a death in the family, bad advice from a custodian, you can request that it be waived entirely. The form is Form 5329. You take the missed amount out as soon as you realize, you file that form, and you attach a short written explanation. That is the difference between a $2,500 penalty and a $500 one on the same mistake, decided entirely by whether you acted before you were contacted. Let me tell you about Lonnie. Lonnie is 76. He has 3 retirement accounts because he changed employers twice in the 80s. And he genuinely believed that taking a distribution from the largest one covered all 3. It does not work that way for employer plans. Each one has to be calculated and satisfied on its own. He was short by about $6,000 for 2 years running before anybody noticed. His preparer never asked, because his preparer only ever saw the one statement Lonnie brought in. He was not hiding anything. He brought in every document he thought was relevant. Nobody ever told him there were 3 conversations to have instead of 1. That is the whole reason the Quiet Rules exists. Plain English, printed large enough to read without hunting for your glasses, on the things that quietly decide what happens to your money, which forms actually matter, what the computer is comparing them against, and the exact question to ask before you hand your papers to anybody. So that a mistake nobody warned you about does not become a penalty nobody warned you about either. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on a television right now, there is a code on the screen you can point your phone camera at. 7-day guarantee. Always. If it does not hand you something you did not have before, you send it back. Flag number 2. The money you moved. This is the most common retiree mismatch there is, and it catches people who did absolutely nothing wrong. You move an account from one institution to another, or from an old employer plan into an IRA. Perfectly ordinary, perfectly legal. The institution you moved it from is required to report that as a distribution. A form goes to you, and a copy goes to the government, showing that a large sum left a retirement account. If that money went into another retirement account within 60 days, it is a rollover and none of it is taxable. But the form does not say that. The form says money came out. So the computer sees a large distribution and looks at your return to see it reported. If your return does not account for it properly, the mismatch is automatic, and the letter that follows treats the entire amount as taxable income. The fix is straightforward, and it has to happen when you file, not afterward. The distribution gets reported on your return, and the word rollover gets entered next to it, and the taxable amount shows as 0. Keep the paperwork from both institutions, the statement showing it left and the statement showing it arrived. Those 2 pages together end this conversation in about 90 seconds. Flag number 3. The business that never makes money. A great many people start something in retirement. Consulting, woodworking, selling at markets, photography, and a great many of those things lose money, especially at the start. Losses are the single loudest signal in this entire system. When a return shows a loss that reduces other income, attention follows. That is true for everybody, and it is particularly true for small, informal operations run by one person. The rule underneath it is what people call the hobby loss rule. If an activity shows a profit in 3 of the last 5 years, it is generally presumed to be a business. If it does not, the agency can decide it is a hobby, and hobby expenses cannot be deducted against your other income at all. Now, 3 of 5 is a presumption, not a law of physics. Plenty of genuine businesses lose money for longer than that, but if you are outside it, you are the one who has to demonstrate you are running a real business. What demonstrates it is not passion, it is behavior, a separate bank account, actual books, a written plan, records showing you changed something when it was not working, evidence you were trying to make money, rather than enjoying yourself and deducting it. Let me tell you about Sybil. Sybil is 69, and she has sold her pottery at craft fairs for 6 years. She has never once made a profit, mostly because she gives most of it away to family. She has deducted her kiln, her materials, her booth fees, and the mileage to every fair against her pension income every year. She has no separate account. The money goes into her regular checking. She has no books beyond a notebook. And she has said out loud at more than one fair that she does not really care whether it makes money. Every one of those things is true and reasonable and human. Together, they describe a hobby, and 6 years of deductions rest on it. That is exactly the gap this guide closes. Not to turn anybody into an accountant, to put the handful of things that separate a defensible position from an indefensible one in plain language, so that a person doing something perfectly honest is not caught out by paperwork nobody explained. Same place, kevinexplains.shop. Link in the description and in the pinned comment at the top. And the code on your screen if you are watching this on the television. 7-day guarantee, no argument. Flag number 4, generosity. That does not match the income. Retirees frequently give a considerably larger share of their income to church and charity than working people do. That is genuinely admirable, and it is also statistically unusual. And statistically unusual is exactly what a computer is built to find. A charitable deduction that is large relative to your reported income invites a question, not an accusation. A question. 2 things protect you completely. For anything over $250, you need a written acknowledgement from the organization, and it must state whether you received anything in return. A canceled check is not enough on its own. Your church will produce that letter if you ask. And for anybody over 70 and a half, there is a better route entirely. You can send money directly from an IRA to a charity. It counts toward your required distribution, and it never appears in your income at all. That matters more than it sounds. Because it never enters your income, it cannot push more of your Social Security into being taxable, and it cannot raise your Medicare premium 2 years later. A deduction cannot do either of those things for you. This can. And there is one more thing here that catches genuinely generous people. If you donate property rather than cash, a car, furniture, anything valued above $5,000, you generally need a qualified written appraisal. Not your estimate. Not the charity's estimate. An appraisal. Skip it, and the entire deduction can be disallowed regardless of how valuable the item actually was. Flag number 5. The casino. When you win above certain thresholds, the establishment reports it. A form goes to you, and a copy goes to the government. So those winnings arrive on the computer side of the ledger, whether you mention them or not. Now, you can deduct losses, but only up to your winnings, only if you itemize, and only if you can prove them. And the government has been explicit for decades about what proof looks like. A contemporaneous log, dates, locations, amounts, won and lost, kept as you go. A shoebox of losing tickets is not a log, and courts have said so repeatedly. So, the arithmetic that catches people is this. Somebody wins $1,200 on one machine and loses it all back across the year. The $1,200 is reported. The losses are not documented, and they are taking the standard deduction anyway, so the deduction is unavailable. They pay tax on the entire $1,200, having ended the year down. And there is a second cost people never see coming. Those winnings count as income for every other purpose too. So, a good night at a casino can push more of your Social Security into being taxable, and it can raise your Medicare premium 2 years later. Entirely separately from the tax on the winnings themselves. Most players' card programs will produce a win and loss statement for the year on request, and it takes one phone call. It is not a perfect substitute for a log, and it is far better than nothing at all. Which brings me to the thing that protects you against all 5 at once. Timing. Documentation created after a letter arrives has almost no weight. Courts have a name for explaining your intentions after the fact, and it is not a flattering one. What carries weight is what was written down when the thing actually happened. So the protection is not a strategy. It is a folder. One folder for the year, with the acknowledgement letters, the rollover statements, the distribution records, and anything else showing what a number was and why. And 2 more things worth knowing about how this actually unfolds, because the fear people carry is usually worse than the reality. Most of what people call an audit is not a person coming to your house. It is a letter asking you to post in proof of one specific item. That is called a correspondence audit, and it is the overwhelming majority of them, which is good news and bad news at once. Good, because nobody is sitting across a table from you. Bad, because if you send the wrong thing or nothing at all, they simply reverse the item and move on. It costs them almost nothing, and it costs you everything. And know how long this window stays open. Generally, they have 3 years from when you filed to question a return. If income was substantially understated, 6. So the folder for this year is worth keeping for at least 3. And there is no benefit whatsoever to throwing it out early. Now, my honest opinion, which is only that, I do not think this system is unfair in principle. Matching 2 numbers is a reasonable way to run a country with hundreds of millions of returns, and it is considerably less intrusive than the alternative. My objection is that it treats an 80-year-old with 3 retirement accounts exactly the same as a corporation with an accounting department. The same mismatch, the same automatic letter, the same requirement to prove yourself, and no allowance anywhere for the fact that one of those 2 has a filing cabinet and a staff, and the other has a drawer in the kitchen. All right, 5 things. 1. If you are 73 or older, confirm you took the full required amount from every retirement account separately, not just the largest one. 2. If you moved any money between accounts this year, keep both statements and make sure the word rollover appears on your return. 3. If you run anything that loses money, open a separate bank account for it this week and keep actual records. 4. Get written acknowledgement for every donation over $250. And if you are over 70 and a half, ask about giving directly from your IRA instead. 5. If you gamble at all, keep a running log. Dates, places, amounts, written as you go. And if your own situation is tangled, write to me. The address is on your screen and in the description below, and I read every one that comes in. One last thing. Lonnie brought in every document he believed mattered, and was short by $6,000 for 2 years. And Sybil has been honest about everything, including the part that undermines her. And 6 years of deductions rest on a notebook. Neither of them did anything dishonest. Both of them are exposed anyway, because in this system, the question is never whether you were truthful. It is whether you can show it. So build the folder this week while nothing has happened, because the people who get through this quickly are not the ones who never made a mistake. They are the ones who could prove what they did. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.